Okay, welcome to Accounts Payable and Accounts Receivable. This is going to be week 1 of class. My name is Sarah Allen and I am the Accounting Specialist Instructor. My office hours are Monday through Friday, 7:30 to 4:30. I'm available after hours if needed. My phone number, my cell, my email. And now we're just going to do a little bit of course housekeeping. I want to make sure that you guys got your messages today that were emailed. If not, you might check your email again in the morning and see if they went through. You need to register with Connect. I'll send an email out on that too. Let me know if you have any ebook issues, but I'm going to walk you through how to go through the Connect and the homework site you guys are already familiar with because you had it last course on your QuickBooks. It's still the McGraw-Hill, and you shouldn't have to register again. All you have to do is just go to the homework link within your website on your My Course Connection and access it there. And you might have to register and just log in with your normal email that you gave the school and your password. Okay, when you're at the course site, you need to check out the expectations, the due dates, the syllabus, and if you have any questions, just let me know. I will show you a little bit about the site there. Okay. I want to share the course site, which we don't have up. Pull it up. All right, here's our course website. Okay, you have your Connect, you have your ebook. This Connect is your actual homework, McGraw-Hill Connect. Here is your ebook for your college accounting. We are working in Chapter 7 this week. Here is your ebook for your college accounting with QuickBooks. Now, when you're on your McGraw-Hill site for the college accounting, you should be able to access that book there. You guys have your QuickBooks from last class. You need to look at your syllabus and your course expectations. Later on this week, I can post due dates here as well if you'd like it. Here's all my contact information. It's always here. All you got to do is copy and paste to get to the email, or just click on one of these and this will get you right to the site that you need to go to. Here's week 1. Here's your learning objectives. Here's PowerPoints. You need to have QuickBooks ready for chapters 1 through 3. And you need to be looking over chapter 7 in your college accounting book. Here are some live lectures from previous classes. You got Ms. Pooja's videos. You got accounts receivable concepts. I don't put these up here and leave these up here to make your life hard. I put them up here to make your life easy. So take the extra time that it takes to review these because it really helps to break down what we're working in for that week. Discussion 1 is due Tuesday. Assignment 1.1 is due Tuesday. Thursday, you have assignment 1.2. Saturday, you have peer responses, and they need to be substantial. They need to add to the actual discussion and not just one sentence of "I agree with you." You will be counted if that's all you put on there. You also need to cite all your work. Check your grammar and punctuation and your spelling, please. Assignment 1.3 and week 1 exam is due Saturday. If you guys have any questions regarding this, you can give me a call. If you want to access your grades, you can always go to this little A right here. And you guys know the user report, the single view, the overview report gives you kind of an idea. I think you guys have the single view and the overview on your guys's. Here's how to access your book. This is one way to access your book. You can click on it and access it. You guys should already have this book in your ebook vital source because you've used this book before. Same way with the QuickBooks. So you shouldn't have any problems connecting. If you do, let me know. And like I said, with that Connect, it's going to have the college accountant book too. So you just click on that, hit connect, and there you go. Here's your homework assignments. Okay. You got all these works that you can do. This is the due dates. All right. Now, if you don't see like assignment 1.1, then that means assignment 1.1 is through My Course Connection, and you need to make sure it's done there. If you don't see the quizzes here, then that means they're through My Course Connection, and you need to make sure that you get them done through there. Okay. So let's go ahead and go back to the slide. If you have any questions, you can email or text me. Please give me enough time to respond. If you don't give me enough time to respond, I can't help. And if you're sending an email to me and sending emails to everybody else, I'm generally the one that's going to respond because I usually just pass it back to me. So give me time. We have 24 hours to respond. I generally try to respond within an hour or two because I know you guys need the help. That being said, I do have to do stuff sometimes and I can't get to the phone. Like today I was in a live class for 5 hours and I could not address any emails or any calls until I got out of the class. So you guys need to understand and let me know what you need and give me a chance to get back to you. Okay, student engagement is critical key to success on these online courses. You have to be here. Attendance is mandatory. I post attendance on Wednesday and Thursdays. Tuesdays is when your first post is due, your initial post. So if you generally post on Tuesday, then you'll be recorded as present on Wednesday. If you turn your homework in on Thursday, when it's due, then you're going to have a presence on Friday. You have to have something turned in. And you guys got to log in more than once or twice a week. You got to log in several times to be successful in this type of environment. And you've got to be diligent, and you got to practice good time management. You're expected to log in twice. I say you log in more than that, and you have to participate. All right. It's the school's policy to not accept late work, but I generally do, but it will have to be 10% late per day. Most of the exams you have two attempts. If you don't, then you need to make sure that when you access that exam, you need to see how many attempts are there, and then follow accordingly. Here's an example of a discussion post that we have. This is what the question was. Here is the answer. A lot of you guys are getting a little confused on when I say we need citation. What I mean by this is you need to not cut and paste. You need to actually take the information you read and put it in your own words, which is called paraphrasing. When you paraphrase, you need to give the author its due. You need to show that they are the original thought process behind your work. So you need to give them their kudos. So in other words, you need to give them their in-text citation and then a reference at the bottom of your work. This is an in-text citation. This is where she got the information, which is down here. So what this tells you is these two authors, and this year this publication was published by these two authors. This brings it down here and it gives it a little bit more information with the title and everything and where you can access it. That is your reference page. This is an in-text citation. This is your reference page regarding your in-text citation. When you have one of these, you got to have one of these. This Haddock's Price Inferno 2015, if you recognize those names, that's because that is your book. This is the APA standard of doing a citation in text. You take the last names of the authors and then you put the year as publicized. Then you come down here and you do your reference for that book. This is the proper reference. If you guys want to copy this and use it, you're more than welcome to. Just remember you got to use this in-text citation and use this reference. Use these to help you go forward on citing anything else. Discussions over 25% of your grade. Your 2 peer posts are due by Saturday. This says Tuesday on your initial, or this says Thursday, but it's Tuesday. Tuesday is your initial post. So you need to have your post turned in tomorrow at 11:55, Tuesday. If you're watching this Tuesday, then you have to have this post in tonight. All right. Homework and assignments are worth 50%. Discussion posts are worth 20. Tests, exams, and quizzes are 20, and live lectures are 10. If you come into a live lecture halfway through, you need to just watch the parts that you missed and then give me a summary of what your take is, what your understanding of those parts that you watched are. Summarize it for me and your understanding. If I ask any questions, you need to address those questions in your live lecture summary. All right, so next. Hi, Mia.
Hello.
Good to have you.
Good to be here.
We are going through the PowerPoint slide. If you have any questions, just let me know, okay?
Okay.
All right, can you see the PowerPoint slide okay?
Actually, it's just you.
Just me? Well, it's not sharing. Okay, how's that?
There we go.
All right. So this week we're going over accounting for sales, accounts receivable, and cash receipts, which is in chapter 7 of our book. It's understanding merchandising. We record sales on account, credit card sales, sales returns, cash receipt transactions, and a general journal. This is where it comes in handy, where we have the T accounts to help us. Okay, we're going to meet Max Out Sporting Goods. It's a merchandising business that sells the latest sporting goods and sportswear for men, women, and children. It is a retail business. Max Farrell is a sole proprietor of the firm. All right, here his chart of accounts. He's got sales, revenue, normal balance, credit, sales of the merchandising. This is his normal chart of accounts. And this is what it's for. All right, journal entry to record a sales of $500 for cash on January 2nd. So we would debit cash and credit sales. And then we do our summary like we went over before. You always got to have your summary of your description of the actual journal entry. Okay, on January 3rd, he sold merchandise on credit. He had a sales slip for that credit for $400. The journal entry would be a debit to your receivables because that person owes it and that's the asset. And then you want to credit sales because that's the income. And then you just give a really good detailed description of what is happening. So merchandise on credit to the customer's name and the actual sales slip. When you put that sales slip in there, it helps to break down the time that you spent or will spend on researching stuff. If you don't have a sales slip in there with a number, then or a name, then you're going to be searching for this transaction forever. So try to put as much information and detail that you can in your description area. It'll make life easier for you and others in the long run. Okay, the journal entry, Roy Anderson, payment of the amount due on January 31st. So he paid what he owed. So it would be an inflow of cash, which would be a debit, and then it would be a decrease to your receivables because he's paying off that receivable. And if this was me, if it was a check that we got, then I would put the check number right here just to break it down a little bit better. The journal entry to record a sale of 500 plus tax for cash follows. And then you have the cash, which is the total amount. That is what you received. That is what you put your debit of cash for. You have your sales tax payable, which is the $40. And then you have your sales, which is the 500. You do not put your taxes within your sales. You have to keep them separated, and you do not record it as revenue. It is something that is a liability. You're just holding that money until you turn around and give it to your proper state authorities. Here you do record the cash sales. Now, you could break this down a little bit more and have a record cash sales with a ticket number if you wanted. That's totally up to you. The more detailed, the less you have to research. The journal entry to record the sale of merchandise on credit. Now we're just doing this the same thing, but it is a receivable. They're actually putting it on their account. So you just do, instead of cash debiting, you debit your receivables. And now here they've got a sales slip 1102. And I'm going to tell you right now, whether you're working with a credit account or a cash account, regardless, you need to have a numbered slip. The IRS doesn't care if it's cash or credit. They want a numbered slip showing proof that you received some kind of income from somebody. Otherwise, they're going to think you inflated your sales to try to make your books look better. So always, even if it's a cash receipt, have a slip. That is imperative. All right, here is their receipt. See, here's a sales receipt. So if you had a cash transaction, he should be recording this on that journal entry, regardless if it's cash or receivables. You got goods taken, or if it's to be delivered. Here's the information to deliver it, and this is generally the way it looks. If you're writing a handwritten one and not putting it in the system. Now, in the system, it'll be pretty much similar. You got a breakdown of the address with the description, quantity, the price, and the total. And then you got your customer's name. If you don't have the customer's name, this is where you would put cash. You don't have to have their name on cash. It's nice to have their name when it's a cash transaction. It just gives more proof of it was an actual true customer. Okay, here's the sales slip. All right. Here's their name, sales tax, and amount. This is just what we recorded a minute ago. This is sales returns and allowances. If something's wrong with the good, then you take a sales return or you give a sales allowance. A cash refund is given in the case of cash sales. A credit memo is given in the case of a credit sale. So if you have a cash sale and they give you the $650, you're going to turn around and give them some or all of that back. So you would credit your cash and debit your or credit your receivables. When you have, or not a receivables, I'm sorry, that was wrong. You credit your cash and credit your sales, or debit your sales, because sales is a normal credit balance. So you want to credit or debit it to take it and lower it. When you have I was thinking ahead, so I had to slow down there. When you have a balance on an account, you don't give them cash. You want to do a credit memo, or what they call a memorandum, and that will offset and lower your receivable as well as lower your sales. So you would do a credit, and then you would, when you do the credit, it'll automatically credit your sales for you. So to recap, if you have a sales return, you want to credit your cash and debit your sales income. And if you have it on a credit card, or not a credit card, but a credit accounts receivable, then you just want to do a credit memorandum to lower that balance, and it'll also lower your sales balance as well. Lovely T account. We love our T accounts. The sales return allowance account is debited to record turns and allowances. Returns and allowances. This is just to show that you sold something and something come back, and you have that account now. So this is a new account you guys aren't used to seeing. So you debit returns and allowances. You debit the sales tax payable, because you're not going to be paying tax on that, because you have that product back and you gave that money back to that customer. So you don't want to pay taxes on that. So you want to take that out of the tax account as well. And then you want to do a detailed description, which is refund the customer for returned merchandise and sales tax paid. And I would even put on here their original sales invoice or service ticket. That way you'd have it on hand if you have to go and research this a little bit more. All right, this count that we just had offsets. The sales return allowances will offset your sales. So it decreases your sales, but they want you to show it as an account. So what will happen is you'll have sales, and then underneath it, you'll have sales returns and allowances. And this is what they call a contra account. And it offsets the original account, which is your sales income account. All right, and here's the credit memo, reducing that. And this reason is for it being damaged. And see, there's a number right here, 101. All right, so here's how it looks on your T accounts. You got your sales returns and allowances, 200. You got your sales tax payable, 16. And then you got your accounts receivable, which is also being lowered, which is 216 altogether. All right, Mia, are you following this okay?
Yes.
Okay, ask me any questions if you have any, okay? All right. Advantage of credit sales and disadvantage of credit sales. The volume of both sales and profits will increase if buyers are given a month or more to pay the goods or services they purchase. That being said, if they don't have cash on hand, they're less likely to buy something from you. If they know that they can do it on credit, then they're going to buy quicker and they're going to buy more. That's just the law of the land. Unfortunately, you got people that are going to buy stuff and not pay for it. So that's going to hurt you. It does increase your profit. I don't see how it's a disadvantage. Oh, but if they only if they pay for it. So if they don't pay for it, then it doesn't increase your profit. It's a loss actually. If payment is not received, the expected profit actually becomes a loss, and the purpose for granting the credit is defeated. But in hindsight, if you do lose some money, you can always record it as a loss or bad debt, and that will help you on your income statement as well. So it's not a total loss, but it is a loss. So you need to closely analyze the customer's ability to pay before granting credit. You don't want to just grant it to everybody, otherwise you're going to hurt yourself. Here's some policies that are in the book, I believe, so you can just research it a little bit more. You want to have tight credit policies, and we'll have a low level of losses. If you have not so tight credit policy, you're going to have increased sales, but you're going to have increased bad debt as well. All right, open account credit. Business credit cards, bank credit cards, cards issued by credit card companies. Those are open account credits. They're accounted for as sales on credit. Sales made to customers using bank credit. Bank credit cards such as MasterCards or Visas are treated as cash sales. Correct. The processing fee charged by the credit card company are debited to credit card expenses. Generally, the business eats those expenses. It's part of cost of goods because it's part of the process of you selling that item or producing that service, and you can expense it on your books. Now, I've seen some places roll that amount up into the actual total of the purchase price. So you might be paying it and not even realizing it. And what's really bad is they'll roll it up in there and charge you more for your than you really thought the item was going to be. So then you could have got that item for somewhere else for cheaper from someone that didn't charge you for that. So you need to check out for that as well. But you want to debit your credit card expenses because expenses are normal debit balances. All right. So Max Out Sporting Goods sells merchandise on January 15th, totaling $900 to customers using bank credit cards plus 8% sales tax. The bank credit card company charges a 3% discount fee. That discount fee is the actual credit card charge. A lot of credit card companies will charge you a monthly fee, a per transaction fee, or a % discount fee, or all three. You just got to watch out. You usually get a bank statement or bank credit card statement showing everything they process, the breakdown of every single charge that they're giving you. So you'll have your deposits that they're showing you minus their charges. So if you sell $900, tax on $900 at 8% is $72. So you got a $972 transaction. If you add 32 or 3% to that, you're looking at $30 almost. That's a lot of money that the business is eating. But then again, it's going on their bank statement or their income statement. So it's going to help offset their net income for this $900. So once you break this all down, the actual amount that you're getting in cash would be the $942.84. That is your merchandise plus your sales tax minus your bank fee. And this is what the bank will actually deposit in your bank account. Now remember, you need to record this sales tax separately. So you'll have a cash transaction for $942, $900 to sales as a credit, and $72 credit to sales tax payable. And the debit would be cash. And here we go, debit cash. Now, you're also debiting your credit card expense. And then you have your sales and your sales tax payable. And this is record sales to customer using bank credit cards. Sales to customers using non-bank credit cards such as American Express and Diner Clubs are accounted for as sales on account. Non-bank credit cards usually take a few days to pay the seller. The amount remitted to the seller is the net of the discount fee, which is what we just went over. And when you have a bank card, they tend to charge a little bit more than your credit card. So you need to watch out for that too. You can become bogged down with charges just to offer your clients the option to pay you by credit card. Okay, what if we sell merchandise for $1,000 to customers paying with American Express plus 8% sales tax? American Express charges 7% discount fee. the discount withheld by American Express would be $75.60. That is 1080.00 times 7%, which is $75.60. So we have accounts receivable, 1080, sales, 1,000, sales tax payable, 80. Then we have record sales to customers using American Express. We have the credit card expense, $43.20. We have cash, 1036.80, and we have receivables, 1080. Record payment received. So this is the actual sell when you do the sell. And then this is when you do the receive the payment. Credit card expense, you expense it as you incur the, as you receive the inflow of cash. It's called a matching principle. And that's helpful on this area because when you get the cash, you want to go ahead and apply your expenses to offset that sale. Special topics in merchandising. Mia, are you following that okay?
Yes, I'm good.
Okay. And I was just, this can be kind of confusing, but this is the sale plus the tax. I didn't put that in there a second ago, but this is the sales plus the tax, which is the 1080, and then you times it by the 7% discount fee, okay? All right, section 2, the objectives. The objectives: compute trade discounts, compute and record cash discounts and sales, and you need to post the general ledger, the general journals you do. And prepare a schedule of accounts receivable. And that's just kind of like accounts receivable aging. Record the payment of sales tax. Okay, this is why it's so important when you have details that when you're going through and you're going through the month and dotty, let's record all our sales, whether it be cash or receivables or credit card. And then you get at the end of the month and you're trying to record the payment of your sales tax, and looky there, lo and behold, you're $80 off what you should be paying the sales tax commission. So then you're going to have to go through each one of those transactions to find that percentage. When you go and do that, you have to look at the journal, and then you have to pull that receipt. If you do not have the receipt number and the proper date and the amounts, then it's going to be a nightmare for you to go and pull that actual physical receipt. So that's why it's so important that you have those numbers on there for your sales receipts or credit card receipts or anything like that. You got to have something that links to some type of paper trail so you can research it in less time than it would if you didn't have that that link, okay? Basic procedures used by wholesalers to handle sales and accounts receivable. They're the same thing as used as retailers. It's the same concept. Except that wholesalers offer cash discounts, which that means is instead of you paying me $150 next month for all these products, if you pay me $75 right this minute, you can have all those same products right now. I'm giving you a discount. That is a cash discount. A trade discount as well. All right. So here's what the general journal looks like. You're getting a accounts receivable 200 or 2,000, and then you have a sales of 2,000. And this is sold merchandise on account. Well, this is, the next one is how it looks if you wanted to give them a discount. So instead of having it to accounts receivable, you're going to have it to sales. You're going to have it to cash. So you're going to break it up though. Part of it's going to go to your sales discounts and part of it's going to go to your cash. And then here's the accounts receivable. So what you do is, so if they paid, I love this, that they've got invoice number, and this is 1 net 10, and this is just due in that 30 days. That's what N/30 is. Just means it's due within 30 days. If you have 1/10, that means you get 1% if you pay it within 10 days. So this is what they're saying. If you pay me within 10 days of this transaction, not when you get the invoice, it's always within the transaction. So you might have a transaction on the 28th and not get the invoice until the 9th of the following month, and you already don't get the discount. You're already too late, and sometimes that happens. So it's always good to get some type of copy when you're actually doing the transaction, if you know that they're going to give you a discount if you pay early, so you can go ahead and pay before they actually get the invoice out to you. Okay. The sales discount on this transaction would be $20 because it's 1% net 10, or so they paid it within 10 days. So here's their 1% of the $2,000, which is the $20. And then you debit your accounts receivable, or credit the accounts receivable for $2,000, and just show that you received the payment on invoice 909. And I would have even put on here paid within 10 days, or even put the original invoice date, so it won't ever come into question that it was actually 9 days apart or 10 days apart. So what you want to do is you want to debit your cash and your sales discount, and credit your receivables. So this increases your cash and decreases your receivables. A customer starting merchandise and paying within the discounted period is only entitled to a cash discount on the balance owed after the return. So if I purchase something and I come back and returned it, and some places charge a 10% restocking fee. So that would be $1,000 minus that 10% restocking fee, and then you can only get a 1% discount on that actual balance after you take that restocking fee off. And you might have prepaid some of it, so you're only going to get a discount on what you actually owe at that time that you're taking that percentage. Okay, here's an income statement, a partial income statement. You got revenue, you got your sales, you got your sales returns and allowances, less your sales discounts. So this is your sales, and you want to reduce it by your sales returns and allowances and your sales discounts. These are called contra accounts. They offset the normal balance of the main account, which, another one would be you got your equipment or land, and then you have your depreciation. Well, the depreciation is an asset account, but it has other accounts attached to it. Okay, and it could be considered your contra account, because your depreciation would be a contra account, because it takes that equipment that you have and it's reducing that balance of that equipment. So if you have $100,000 farm equipment and you have depreciation of $70,000, you only have actually $30 of farm equipment, $30,000. That would be considered the fair market value of the equipment, your book value. That would be a contra account because you're taking the main account and you're offsetting it by a balance to get a total imbalance of what that is. So that book value of that equipment is, you know, $30,000. Now that can also be, like I said, the fair market value. If someone comes and offers you $30,000 for it, then you broke even. If someone offers you $40,000 for it, then that would be the fair market value, and then you got a $10,000 gain. If someone comes and offers you $20,000 for it, well, you've just lost. You have a loss. The fair market value is less than what your book says, so you have a loss. So there's going to be several of these accounts that you're going to encounter. If you're ever confused, go look at your basic accounts and then see what they do. Is that an income account and it's not an expense? So why is it offsetting your sales if it's not an income account? Well, it's a contra account. It's reducing your income, even though it's not considered an expense. All right. Here is your accounts receivable ledger. And this is just the description. You got your debit, your credit, and your balance. So anything that comes in, you want to debit. Anything that is paid for, you want to credit. And then you balance it. You balance it after every single transaction. You always balance it after every single transaction. This goes for any ledger, any journal. You always want to balance it every single time you touch it, because if you don't, then when you do balance it, you're going to have a bloody nightmare on your hands, because you might get out of balance and you don't know where to find it because it was 10 years ago that you forgot to balance it, and you're looking for 10 years of transactions trying to find one little transposed number. So always, always, always balance it every time you do a transaction. All right, sales, returns, and allowances. These are journals, and it's showing you from the journals. There's your sales tax payable. So you got your sales returns and allowances. These are the journal numbers, the transactions. And then you got your payable. You got your accounts receivable. Accept return on defective merchandise, credit memo 101, original sale made on the sales slip 1102 of January 8th. See, I love that. All that information, and then it takes you 2 or 3 minutes to write it, but it's going to save you hours later on. Okay, this is the person and the address that you sold this stuff to. Here's her sales slip, and here's her credit memo. So on this individual person's ledger, you've got the sale of $648,000 minus $216 credit, giving her a total of $432. She has a credit right here, which is number 31 on the 31st. So that tells me that she probably paid. We don't have it up here, so we don't know, but I would logically assume that she paid this. So, you know, they need to write that in. All right. Oh, here we go. Indicates the amount was posted to the accounts receivable account in the general ledger. The check mark indicated that the amount was posted to the customer's account. That's check mark. Okay, good going. The use of accounts receivable ledger does not eliminate the need for the accounts receivable account in the general ledger. However, the accounts receivable account in the general ledger is now considered a control account. Ooh, you can't read that. At the end of the month, after all postings have been made, the balance in the accounts receivable ledger must be proved against the balance of the accounts receivable general ledger account. So basically what it's saying is you got all these customers and you've got all these balances. So what you want to do is, and believe it or not, these can be off. They can be off. What you want to do is do like an accounts receivable aging or accounts receivable total report on the total amount owed that people owe you. And then you want to go and pull up your general ledger for your accounts receivable. And you want to make sure that the two end numbers match. If they don't match, that's when you have to go and research why something's not matching. More than likely, someone posted something to the wrong account and it didn't hit your general ledger the right way. And that's generally what happens. Or they transpose the wrong number. So you have to investigate. That's why I always try to check these periodically. I don't wait until month end. Then you're rushed to get all your reports done, and it's a bloody nightmare. So try to do it more often than month end, just to have it as your own separate control. So total of the individual customer balance should equal your accounts receivable balance. And believe it or not, in QuickBooks, you'll run into this problem too. If you're posting something incorrectly, like a credit memo, it will throw off these two balances. So you got to watch out what you're doing. Prepare a schedule of accounts receivable. Here's the schedule of accounts receivable. You got your in balance. And you're going and putting it on your report under that person's name. So you're taking the balance off their individual ledger and you're putting it on the accounts receivable report. You're just doing the in balance. So accounts receivable ledger transfers into individual balances to the schedule of accounts receivable, which then turns around and should equal your accounts receivable balance in your general ledger. At the end of the month, after all accounts have been posted, the goods company, the sporting goods company, prepares the sales tax return. This is always important too, that you need to check your sales tax to make sure everything's right as well. QuickBooks, you have 2 or 3 reports that you can print out and check it against your actual sales tax payable to make sure everything's kosher. 3 accounts that are involved in the paying of sales tax. You got your sales tax payable, you got your sales, and you got your sales returns and allowances. These 3 accounts always have to be looked at when you're paying your sales tax. This is a report of your sales tax computation. This is, I'm not even for sure what company this is or what state. It's just a generic one. But basically, you got your number you got to have on there. And in Oklahoma, you got to actually go and do this online now. They don't accept these, but online. You got your first date right here. This is your work, your business EIN, your company's name. And then it's broken out like this in any type of state. Whatever state you're in, it's broken out. Gross minus this, minus that, times this, times that. So just follow it step by step. Take it one step at a time, and it's not so overwhelming. It's pretty easy if you do it one step at a time. Basically what it's saying is take your gross receipts, add any personal property, retail license for resale, we don't have any. Add any use tax, we don't have any. Foot it, which is calculated. So we don't have any of these others, so it's 25. Less allowable deductions. If you have any deductions, you'd put it right here. Then you would net it. Okay, so after this $25,000, we have $2,000 in tax that we need to pay, minus less taxpayers discount. They had a $20 tax discount included in their bill when we did that memo, so it's less that. So now we owe $1,980. So you got $1,980 that you need to pay the state. So you take that out of your sales tax payable. So taxable sales minus your percentage is your tax due. So the 25,000 times the 0.08. And it's generally not so easy as this because sometimes you have several counties that you have to account for. Like here in Tulsa, you have to account for Tulsa County. You have to account for Oklahoma City. The state, it ends up, it's 8.517%. If you go to a different county besides Tulsa, then you have a different calculation you got to do. So you might have 4 or 5 of these calculations you got to add up to make sure you have the right ones, and then you do the sales tax due, and you do the calculations. All right, that is it. Do you have any questions for today?
No, I don't. It seems all pretty straightforward.
Okay, well, if you run into any problems, just let me know and we'll take care of it. And you might watch what little that you missed. And I don't know how late were you?
You were still explaining just how the live lectures worked, I think.
Okay, so just watch what you have, and if it's just a few minutes, don't worry about a report. But if it's more than 10 minutes, then give me a few sentence summary of what you missed, and then we'll
Okay.
go from there. And I should have it up tomorrow. Okay.
Okay. Are
Thanks
these
for
going to be
joining.
at 6:30 on Mondays?
Yeah,
Okay.
yeah, 6:30. We are running a little bit late today because we had I was doing a live lecture before and we just kind of ran over. So if I'm not right at 6:30, then that just means I've ran over a few minutes and I'll be on immediately after I get off of that other one.
Okay.
Okay. Thank you, Mia.
Thank you.
We'll see you next time.
Have a good night.
All right. Bye.